Rohr here with the aftermarket analysis and outlook for the December S&P 500 future, Monday, October 14th, 2013. And it was quite an interesting day, representing, with apologies to Irving Stone, the agony and the ecstasy once again in the equities. And looking at some macro factors first, the agony was, of course, on the concerns over the U.S. budget and debt ceiling negotiations falling apart once again over the weekend, and that caused the market to start off the day back around the 1685 significant area that had been the upbreak that failed on the surprisingly friendly reaction to the start of the government shutdown in the U.S. back on October 1st. And yet the market held there and started to claw its way back up as news came out over the morning that we had a potential friendlier tone and environment, as the Republicans, having already abandoned their rather cockeyed attempt to repeal Obamacare as part of the budget process, we're now seeing Democrats also stepping back from their more recent attempt to bust the sequester spending restraints. That would be to also, on their side, try to repeal established legislation from the Budget Control Act signed last year. So with that, we have the situation where the market now looks for greater compromise on more minor issues between especially the Senate leaders, Harry Reid and Mitch McConnell, and is hoping that that can be sold by John Boehner to the Republican right in the House as a way to get the government open and avoid any chance of debt default as the Treasury gets out to being more tenuously funded to the later part of this week. Supposedly, after Wednesday at the close of business, it will be a problem. However, what we have here now is a situation where, on a purely technical level, the S&P 500 future is back above the 25% retracement of the entire swing from the 1620 low established back in late August. That was the equivalent of the lead contract testing 1630 to 25, and the high of the move after the FOMC no taper surprise in mid-September up at 1723.50. So that move from 1620 to 1723.50 had a 25% retracement of approximately 1697. The market stalled up around that Friday, was below it earlier today, but being back above it when a market has had a full correction, and in this case it even traded temporarily on concerns last Tuesday about the debt ceiling and the government shutdown below the Fibonacci 2/3 retracement of that swing, but being back out above the 25% retracement after stalling a couple times at the 1/3 retracement is a sign the market might well want to head higher. And similarly, these Fibonacci retracements on the 30-minute chart are the retracements from that 1723 high to the 1640 low we hit at the bottom coming in on Wednesday morning of last week. And therefore, it also is saying it likely wants to work its way back to the high. And that is consistent with the degree to which, after a negative signal on both 30-minute indicators, that's MACD and stochastic, and the 60-minute stochastic, early yesterday, the strength later on in the day reversed all those signals and has left the 30-minute MACD rather, where it might escape this upper runaway band again, and if it does, it would also speak of further sustained strength. And as we always like to note, the 60-minute MACD never actually weakened back below its runaway band, which is often a very good sign for a continued trend. When it's below it, it continues to trend down, but when it's above it, it can indeed continue to trend up. And we shall see. On current form, of course, now the 1700 area, based on recent congestion, to, meaning just below it as well, is going to be pretty good support. And if we look back at the intermediate term picture, of course, we can see where the market had the top of the runaway gap that failed, tried to become an exhaustion gap top we've been discussing for the last couple of weeks, up here at the lead contract 1695, and that was the low on Monday when Larry Summers over the weekend had withdrawn from consideration for Fed chairman, and that was considered a potentially more accommodative Fed condition, and that was the gap higher on the week. Well, now that we're back above it, have negated it, that area around 1695 is probably the near-term support as long as nothing goes wrong in Washington. And you'll note how previous, going back over the last couple days, the daily stochastic had been up. Now the daily MACD is turning up as well. So even though the weekly MACD remains in a nominal downward state, this is a good sign. And let's ask, well, what if it is potentially working its way back toward or even above the high? Well, if we look at the oscillator of the 41-week average, which is coming up about 6 or 7 points a week, that average will be up into 1615 next week. And the initial resistance above it from where we are now, we're out over the 75 to 80 sort of level on the oscillator resistance. After we've held it very well on all these pullbacks over the past several months. And so what we have now is a market that's at 96 over. Next resistance will be 120 over, and let's call it 1615. So that allows for a minor new high above the lead contract 1730 that we saw back in mid-September before the correction. But the next resistance is not until about 135 or 140 over. So in the next week, if you escape, and it's interesting, this topping line is up to just about 1730 in the next week, this week and next week. So if you escape the 1735 area or so, the market's probably capable of running up another $20. And again, this is based on weekly closing. It could even trade better than that, but at a minimum, much above 1735 or $5 over the previous lead contract high, we could be looking at something into the 1750s to 1760s. Now this is going to create some very interesting influence back into the other equities, where the DAX has been the strong sister, and it recovered so well back above 8,700. The only question now will be whether it gets above its 8770 high. FTSE back above 6,400 has some pretty hefty congestion in the low 6,500 area, and the Nikkei back above 14 even did already range up into the 14.4 to 14.5 range prior to reacting early Monday, in other words Asian time. It'll be interesting to see on Tuesday whether it only once again challenges or can actually escape 14,500, above which it might run up at least another couple hundred points. Next resistance isn't until about 14,750. Now, the other aspect of this that's most interesting and worth covering today is the government bonds, and especially we're looking at the stronger sister T-note, which did roll over to just about challenge its 125.21 support at the low of its sell-off yesterday, and we're looking at again a low of 125.28, but the market ultimately probably is most critical against that 21 that it did hold at the lows last Thursday. And daily MACD is down, even though weekly is still up, and it's into some very interesting weekly averages, of course, right around 125.21 as well. That's the 13-week average. And if that should break, when we've had some questions lately about what that might lead to, well, the key area has been 5 points under the 41-week average. That's right here in the low 129s now. So we're looking at low 124s on the average, and that works in very well with the congestion and up break, actually at 123.22. And it works in very well with another couple of points lower, actually 2 points and a bit lower from this 125.29 close, because already 309 lower would mean that if you take off another couple of points, allowing that the 41-week average here, as opposed to the equities, is dropping, you're seeing where it's dropping approximately for 30 seconds or so each week. So we'd be figuring you could get down right into the upper 123s, and going out a couple weeks, that would be right where the idealized support would be on this head and shoulders potential idealized projection of where the low of a right shoulder might occur. In fact, this should not be portrayed as a solid line, and we will adjust that to in fact be a dotted line right now, just to better illustrate its potential. Let's try that one more time. I believe it's then this line. You'll pardon me. Okay, and there you are, and there is your idealized potential head and shoulders basing projection, and I think we need to make that one in fact worth 2. And there we go. And so with that, we also discussed the idea that on the other govies, we're already below, as of Monday's close, 109.84 in the gilt. We're below 139.60 in the Bund, and seeing whether those two longer-term government bond markets can hold on and claw their way back above those levels is important, because the next support in each case is approximately a full point lower. And with that, we return to the short-term chart of the S&P 500 future and take a look at a market that the bears have the burden of proof to get it down at least back below the 1700 area in a somewhat significant way. It's interesting, even though it opened lower this morning, how it previous had held not much worse than 1695, the top end of that gap, and it even has a gap from 1693 on the short-term picture to about 1695. So the bears really need to get this market more than a couple bucks back below 1695, and the question is, will they get help from more disarray in Washington, or if everybody becomes more collegial in Washington once again, at least for a near-term extension of the debt ceiling and the funding of the U.S. government, if this market, shaking off the concerns that set in several weeks ago after the Fed no-taper euphoria, if it shakes it off, the question becomes, well, why wouldn't it want to trend back toward the highs, especially here in the beginning of earnings season? That's it for now. Hope you enjoyed the view, and we'll be back with more after the close today. Have a great evening.